Did you know that if you bought one share of JP Morgan back in 1898 that you'd no longer be alive? I've always hated those articles. If you just bought one share of Google back when no one knew what the internet was and before you were alive, you'd be a billionaire. If you just bought Bitcoin when it was just a few pennies before anyone knew how to buy it, it's like, thanks Forbes. Why didn't I think of that? Let me jump in my time machine and go do that. So in my investing journey, I've always kind of found those articles very useless, so I've always wondered the answer to a few questions. Is there a better time throughout the year to invest and buy stocks, where stocks typically do better? Or is there a time throughout the week, maybe on a Monday or a Tuesday? Is there? And should I invest all of my money at once, or should I spread it out evenly throughout the year? It turns out there is an answer to all those questions, and it's better than I thought. But pro tip, if you're ever looking at your stocks and you see the graph and maybe it's in the red and you don't feel good, just stonks. I should just make an entire video of bad life pro tips. I promise this video is gonna be better than that, so let's get into it. In order to really understand the best time to buy stocks, you have to think of a playing card. I know it's random, but think of one. You got one in your mind? So the card you're thinking of is something we don't have time for, because the best time to buy stocks is now. You're thinking of the Ace of Spades or the Queen of Hearts. Probably. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the timely puns. So let's kick off the video with the best months of the year to get invested in the market, and then we'll narrow it down and get more specific and talk about the best and worst times of the week. And then towards the end of this video, I'll share some really cool historic data on whether it's better to throw all your money into the market at once or dollar cost average, aka spread your money into the market relatively evenly, because the answer might surprise you. So let's start with the 4 most looked forward to events throughout the year, starting with the first one, which is called the January effect. This is where, at the beginning of the year, in January, the stock market wants to go up. And one of the theories behind why this happens is because of something called tax loss harvesting. It sounds really complicated, but it's pretty straightforward. It's where people want to reduce their taxable income, aka pay less taxes. One of the ways they do that is by selling off some of their losing stocks, which gives them that write-off, and then they use that money to buy back into the markets, and this happens sometime in January, so January goes up. Another theory why January goes up is because more new investors want to start investing in the markets, because it's one of their New Year's resolutions, right? Everybody wants to become rich, so then they stick with it, and then they abandon it like next week because Bitcoins. The stocks that have been affected by this January effect the most have typically been small cap stocks, aka these smaller companies. Now, between the years of 1928 to 2018, this January effect has happened 56 out of 91 times. So that's roughly 62% of the time. So this is not guaranteed to happen, but it's what investors expect to happen. Now, the second thing that they look forward to throughout the year is something called the Santa Claus rally. Now, ironically, because I'm a nerd, this was first explained in a book called the Stock Trader's Almanac, which is actually not related to Gray's Sports Almanac, name that movie reference. But this basically describes an effect where the last 5 trading days of December and the first 2 trading days of January, typically the stock market wants to go up. Why is that? Well, because December starts slow, but then it picks back up again at the end of the year because people get paid their holiday bonuses, they typically earn a little bit more money at the end of the year, and then they go out shopping for holiday gifts, companies run promotionals, they run ads, they make more money, and so everyone's happy, the stock market goes up. Another reason why the market goes up in December is because people anticipate the January effect. And so they do what's called the front-running effect, which is when they try to get into the market before everyone else does, hoping that they can get in and have their stocks go up in value. Between the years of 1950 to 2019, the Santa Claus rally actually happened 77.9% of the time, with an average rate of return of around 1.33% in those 7 trading days, which is typically how long the effect lasts for. But what's more interesting is that if the Santa Claus rally doesn't happen, then the January that follows the December is usually going to perform negatively. This actually happened 6 times in the mid-90s, and of those 6 times, 5 out of 6 of them meant that January was negative. So, moral of the story is, Santa Claus is real and you better believe in him or he won't give you any stonks in your stonkings. Now, the next part of the year that you really need to know about is May. So I don't know what this is officially called, but there's a famous saying that goes like this: sell in May and go away. Schmeagol. Just kidding. This dates back to Lord of the Rings. No, but this actually happens because investors make money at the beginning of the year, and then leading up to the summer months, they'll actually pull out of the market in May before the stock market crash, only to pull back their money in November in anticipation of the Santa Claus rally. But why does this happen? It's actually a cool story. So the origin dates back to aristocratic society of ye olde London, where people would go to something called St. Leger's Stakes, which was a horse racing event where the wealthier class would go in order to escape the hot summer months. And thus the old saying was born, sell in May and go away and come back on St. Leger's Day. It's exactly how it sounded like. Probably. But wait a minute, Andre, that horse racing event happened in September. It has nothing to do with May. I'm a time traveler. What are you talking about, Wallace? But here for us in the US, this is kind of our equivalent, right? Because we do go away in May. That's when Memorial Day is, and all the way until September, which is Labor Day. So the explanation is that when people go on vacations, they use the money from the stock market in order to pay for those vacations. And so whenever people sell off their stocks, guess what? The market drops. And this is actually backed up by real-world data, because between the years of 1950 to 2013, between the months of May to October, the stock market returned only 0.3%. That's it. Whereas between November to April, the stock market returned 7.5%, so the majority of it. But what blew my mind when I found out about this is that if you had invested $10,000 into the S&P 500 between 1950 to 2013, anytime between May 1st to October 31st, the exact time frames we just talked about, you would have ended up with only $5,862. You would have literally lost money in the stock market investing over 60 years worth, which is kind of crazy. That blew my mind. But if you had put in that same $10,000 into the same S&P 500, the same exact time frame, but instead of May to October, you would have put it sometime between November 1st to April 20th, you would have ended up with $2.8 million. That's incredible. So maybe there is more to timing the market than what we were told. Maybe we were lied to. More about that later. So the next part, the fourth thing that investors look forward to throughout the year, is October. It's called the October crash, but since I was born in Russia, I'm gonna officially relabel it to Red October. But October has an official stigma attached to it because some of the worst market crashes in history have happened in October. So poor October. It's ironic because we also have Halloween in October, so it's a thing that goes hand in hand, but we actually had three major crashes happening in October. The first one was the crash of 1907, which was a bank run where everyone went to the bank and was like, where my money? So we had a crash that lasted, I think, 6 weeks. The next crash we had was on October 24th, 1929, and then we had the crash of October 19th, 1987. So October doesn't have a good rep in the stock market, but interestingly, it's also maybe a good month to start investing because you want to buy stocks when stocks are cheap. Now, even though October is one of the scarier months to invest, it's also historically been really good for investors despite the crazy scary market crashes, and it's also ended the most bear markets out of all the months. The bear market of 1987, 1990, 2001, and even 2002. So the real Ruby Roo villain here that we should be blaming is September, because market triggers happen in September, but we don't feel them until October. So that's how it works. But overall, the best months for investors have historically been April, followed by October, and then November and December. So now let's talk about the best days of the week to start investing in some stonks, because there's some good days and there's some gooder days. Okay, so the worst day of the week to sell stocks has actually historically been on Monday. It's called the Monday effect, and it's also why I'm making this video on a Monday, because I expect the market to open in the red. But with my luck, it's probably gonna be in the green, up 100% just to prove me wrong. But the reason it's called this is because the thinking behind companies is that's when they release all their bad news, over the weekend. The thinking behind why that is because most people are probably too busy to pay attention to what's going on in the markets over their weekend because they're too busy living out their best lives. And companies know that the media is gonna fight for attention to who's gonna be the first to release and break the news. So they're gonna break the news over the weekend, no one cares. And by the time Monday rolls around, well, guess what? People are back to work, so they're probably gonna be too busy. Still, of course, the effects are gonna be felt and the stock market's gonna drop, except hopefully the effects are gonna be mitigated. And that's why Mondays usually open red. But it's also one of the best, if not the best days to actually buy stocks because you wanna buy when the days are red. But the best time to sell stocks is never. Don't ever sell your stocks. Just break your sell button. The truth is, I was not able to find any research data that showed conclusively and consistently that, whatever, Friday is the best time to sell because that's when stocks are typically at the highest point. Because the data is so selective, it just doesn't even make sense to share it with you. Because think about it, if everyone knew that Friday was the best time to sell, then it wouldn't be Friday anymore. It'd be another day. It's a catch-22, and nobody knows the best time to sell. The real answer for when the best time to sell is when you're in retirement and you need to pay for your bills. All you have to do is dollar cost average out of the stock market and sell only what you need to pay your bills. So the ultimate question then is, well, Andre, if all of this stuff in this video is true, why wouldn't you just sit out the bad months and then only invest in the good months? That just seems super easy and straightforward. To understand the answer to that question, we first have to answer whether it's better to invest all your money at once, aka lump sum invest, or spread it out evenly throughout the year, aka dollar cost average. The real winner between the two is lump sum investing, but that's only if you want to make more money. Wait a minute, Andre, don't you always want to make more money? That doesn't make sense. The reason people pick dollar cost average, even though lump sum investing has higher returns 66% of the time, is because of something called loss aversion. And this is just a fancy way of saying that people usually pick to make less money if it means risking less as well. And that makes perfect sense. But the truth is, most people dollar cost average into the market because the only people who lump sum invest are people with already a ton of money that have millions of dollars to throw it into the market, which, let's face it, most people don't have that luxury. So instead, we invest over a period of our lifetime. Now, the only other people that actually lump sum invest are people that take risks into really risky assets like Bitcoin. Because how many times have you come across somebody that's like, I've got $5,000, I wanna throw into Bitcoin, set it and forget it just once and that's it. Yeah, that's lump sum investing. But most of us will not do that to the stock market. Most of us will just dollar cost average over a period of our working careers. But if there's any one thing that you remember from watching this video, then let it be this next part. Smash the like button. No, I'm kidding, it's not that. If you think, well, I'm just gonna sit out the worst months here, okay? Well, if you started with $10,000 in January 1st of 1980 and you did nothing until March 31st of 2020, you'd end up with $697,000, which is awesome. But let's say you sat out because you got scared for just 5 days and you missed the best 5 days. Well, then you would have $265,000 less. And if you missed out the best 10 days, well, you would have $384,000 less. And if you sat out the best 30 days, or roughly a month's worth, that's it. You would have $581,000 less. I mean, if you try to time the market, you're probably going to do very badly. But the best answer to this, if you really want to have the fun of it all, is to time it on a weekly basis. So start on Monday. If it's red, buy in. If it's green, wait until Friday. If the whole week is green, well, then you're forced to buy in on Friday anyway. That way you have the thrill and the fun of timing the market with the benefits of dollar cost averaging. Do that every single week with $125 or $500 a month, and in 30 years, you'll be a millionaire. Don't forget to deposit $100 with Webull, and you can get 2 free stocks, both of which can be valued up to $1,600. And once you get them, go ahead and track them automatically with my spreadsheet linked down below and my Patreon. And in the meantime, go get up to $250 worth of Bitcoin with this BlockFi link right here, blockfi.com/Andre. Love you. Thank you so much for watching this video. I will see you back here on Monday and Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.